Hi, everybody. Welcome to this edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. If you're a regular viewer of our program, you may recall an episode we did back in December 2022. We explored an approach to selecting Canadian dividend stocks called Beat the TSX that certainly lived up to its name over the past 35 years. The method has outperformed the benchmark S&P TSX index over the past 3, 5, 10, 20, and 30-year timeframes as of the end of 2022. Now, despite those stellar results, Beat the TSX is best understood as a research tool rather than a formula for success. And there are many ways to apply it that might not be as straightforward as you might think. So, we're going to get some perspective on putting it into practice from a true scholar of the method. Joining us is Matt Poyner, founder of the blog Dividend Strategy. Matt, nice to have you back on the program. Thanks so much for taking the time.
Thanks, Caitlin. I'm glad to be here.
So, Matt, tell us, what attracted you to the Beat the TSX method as a DIY investor?
Yeah, well, that's really how I come at this. My entry into the world of personal finance is a little bit unusual. I don't have a degree in business or economics. My background is in medicine, actually. So I'm a science guy. So when I was starting to build my own portfolio as a DIY investor over 20 years ago now, I was looking for something that was a little bit more data driven and scientific than something that was just based on somebody's opinions or predictions. And so that's really what attracted me to the Beating the TSX method in the first place. It's totally transparent. It's rules based. It's was simple enough for me to implement as an amateur investor way back then. And the truth is, I was also attracted by the excellent returns that it had even at that point in time as well, which had been tracked very transparently. It was something that I felt like I could rely on and I could use to kind of build the backbone of my own personal portfolio.
Those are all very reasonable reasons to decide to go ahead and follow this strategy. And you've taken over as the steward of the Beat the TSX method from its creator, David Stanley, keeping up to date each year with the data. Why did you decide to take up that mantle?
Well, really, it was offered to me by the Canadian Money Saver magazine, which is where David Stanley had been writing those articles for years and years and years, since the mid 1990s, because I'd already been writing for them occasionally from the perspective of a DIY investor. And so when they gave me the chance to do that, it was really a no-brainer for me. I immediately said yes. Partly because it was an honor, but partly because I felt like I could grow that effort. I immediately knew that what I wanted to do was to create a website to publish the method, kind of the details of how to actually use it in real life. And it also served as a platform for me to talk about other issues that were really relevant to DIY investors. What that's really grown into is that it's also a place where people can come and they can comment and they can kind of network and kind of see what other people are thinking. I do provide one-on-one help as well through the website, but dividendstrategy.ca is not an advertisement for that. I want it to stand on its own and be a valuable resource.
You definitely got your hands full. You took on one job and then all of a sudden filled up on a lot
It's a
of
lot of
other
fun. I
other
love
ones.
it.
That's awesome. All right, before we get into our conversation, I have a trivia question for our audience. How many years has the Beat the TSX method outperformed the benchmark S&P TSX 60 index between 1987 and 2022? So we'll reveal the answer at the end of the conversation, so stay tuned. Now, just one quick note for our viewers before we dive in. We're discussing some of the investing lessons Matt has learned using the Beat the TSX method. They're based on his personal experience given his unique investing goals and needs. They may not apply to all investors, so take them as considerations to keep in mind in your own investing journey. With that said, let's get going. First off, some of our audience might not be familiar with the Beat the TSX approach to selecting stocks. So, can you fill us in on how it works?
Yeah, it's super simple. There's really just three steps. The first step is to look at the list of TSX 60 stocks. So this TSX 60 is Canada's blue chip index, so the largest companies in Canada. You look at that list of TSX 60 stocks and you organize it by dividend yield from highest to lowest. Second step is you take the top 10 stocks from that list. So the top 10 yielding stocks from the TSX 60 list, and you buy them in equal parts, equal dollar amounts, and you hold them for 1 year. And then at the end of the year, you look at the updated list and you rebalance according to the new list. So that's really the very simple method that I track very consistently and transparently year after year after year. The truth is, most investors who use the beating the TSX method, though, don't necessarily use it as black and white and dogmatically as that. It's really best used, as you alluded to at the beginning of the webinar, actually, as a tool to identify potential investments. And I think we're going to talk a little bit more about how people like me and other beating the TSX investors actually do that. But that's the simple method, really just 3 steps.
Okay, yeah, it sounds pretty straightforward. Just have to find the information and stay strict and kind of go ahead and purchase. So, with that being the case, what would you say are some of the potential benefits as well as risks with this kind of approach?
Lots of benefits to this approach, and it's really being borne out over time. The first one is that it's really super simple. It's simple to both to understand and to execute, even for DIY investors. The second is that it's low cost, especially compared to your typical mutual fund or even some index funds out, ETFs out there. The third is that it's not speculative. It's very methodological, it's very rules based, and we're only buying big, stable, blue chip companies. The fourth thing is that it generates income. Those stocks are selected based on their high dividend yield. And then lastly, to the other benefit is that historically the method has produced quite high returns. Of course, we don't know if that's going to continue going forward, but regardless of the time period you look at, whether it's 3 years, the last 3 years, 5 years, 10 years, 20 years, or 30 years, the average returns for beating the TSX have actually beat the index over any one of those time periods, which is pretty incredible. The underlying index total return over the last 30 years has been about 9.5%, and beating the TSX has averaged a little bit over 12% over the last 30 years. So that's about a 2.5, little bit over 2.5% difference over that time. If you were to have invested $10,000 right at the beginning of when David Stanley started tracking the data, so about 35 years ago, that would be worth over twice as much now versus if you had invested that $10,000 in the underlying index. There's a bit of an inherent value play that's kind of worked into the beating the TSX method. Sometimes sentiment is low for one reason or another, drives down the stock prices, they arrive on the list, and then hopefully that lower sentiment, the reasons for that is temporary, they recover, and we get price appreciation in addition to the dividend. That's if all works out as it quote unquote should. So those are the big benefits, 5 big benefits to the method. But I'm very transparent that there are also risks involved, or kind of compromises that are involved with the beating the TSX method as well. The first big one is lack of diversification. Beating the TSX stocks do tend to be concentrated around just a couple of sectors, banks, utilities, and telecoms. So that's the first thing. The second thing is that there's some behavioral risk involved. Whenever you're buying individual stocks, there's the temptation for some of us investors to become a little bit too active, to start kind of trying to pick stocks that are going to do better than others, make predictions, things like that. And that usually leads to worse outcomes over time rather than better. The other behavioral risk that can be involved in beating the TSX is that even though the long-term performance has been great, which means that on average, it does better than the index. Sometimes it doesn't do better than the index. There are certain years where it underperforms, sometimes significantly. You need to know about yourself that even if a good strategy like beating the TSX underperforms temporarily, you're going to be able to stick with it. So there's that kind of behavioral risk as well. And then the last risk is kind of a price or a dividend risk. As I was saying before, there's an inherent value play in this method. And most of the time, these big companies recover from that temporary lower sentiment and lower stock price, but sometimes they don't. Sometimes the prices don't recover. Sometimes dividends even get cut. And so that's a risk to be aware of going in as well.
Okay. All seem completely reasonable. You can't have all the good stuff and none of the bad stuff. So you always got to weigh it out somehow. And just a quick note to our audience, Matt unpacks the historical performance of the Beat the TSX approach in our previous webinar. So check it out if you want to learn more. It's called How I've Managed to Beat the TSX the Past Decade, and it's available in the Learning Center on Webbroker and on TD's YouTube page. So thanks so much for running us through the basics of the Beat the TSX method, Matt. I want to now take a moment to show our audience how they can actually look these stocks up that meet the criteria you mentioned within Webbroker.
We're going to click on Research. Underneath Markets, we're going to go to Indices. This will bring up kind of our overview of indices page, and we're going to focus on the left-hand side here where it shows all these major indices, and we're just going to scroll down and click the S&P TSX 60. It's going to pop up this little chart here, and we're going to click on Members to get the full listing of stocks that are included in the S&P TSX 60. Once we're here, we're going to go ahead and rearrange these stocks based on dividend yield, that important criteria for this particular strategy or method. We're going to click dividend yield, and it's going to automatically rearrange these stocks from highest dividend yield to lowest dividend yield. So right there, that easily we can find out what the top 10 dividend yield stocks are on the S&P TSX 60. Now, of course, we're going to want to do some further research on these individual stocks to see if they might be something we'd want to be interested in investing in. So what we're going to do is we're just going to go ahead and click on one of these securities, and we're going to click down here on the overview. Now, this page is where we kind of house all the information about individual securities within Webbroker. On the top, we have information about the price. As we scroll down, there's lots of reports and news available. Fundamental information's over here, including that dividend information like the annual dividend rate, ex-dividend, and pay dates. If we click on fundamentals, that will actually take us in and allow us to see a comparison for this company to other companies on different fundamental information. So it's industry comparison, so the industry average, or we can click on peer comparison and see that company versus its peers and how its results compare. Finally, we'll look at charts as well. So charts not only will allow us to see kind of the price history for this particular stock, but we may also want to add the dividend yield as one of our lower indicators. So we're just going to click lower indicator dividend yield, and then that will show right below the chart how that dividend yield has fluctuated over time. So again, just another piece of information to help us research these Beat the TSX stocks a little bit further.
All right, let's get into some of the lessons that you've learned using the Beat the TSX approach. Your first lesson is that diversification beyond BTSX stocks is important despite its strong past performance. So tell us about that.
What the academic research tells us is that diversification is really one of the only free lunches in investing. It improves our risk-adjusted returns. And that's really significant. So beating the TSX really does kind of serve as the backbone of the Canadian portion of my portfolio. But there would be two problems with it constituting 100% of the Canadian portion of somebody's portfolio. The first is that there's really just too few stocks. 10 stocks is not enough in order to attain adequate diversification. And then the second reason is that, as I mentioned before, beating the TSX stocks tend not to be diversified well outside of the telecom, utility, and financial sectors. So the way that I try to address these issues is within Canada, I will expand out from those sectors that beating the TSX does identify stocks for. I go to the TSX 60 list because I still want big, stable blue chip companies. And I'll look for other stocks in other sectors that might not have the highest yield, but they have a really strong history of dividend growth. And because the research says that dividend growth is, depending on what study you look at, can be just as powerful a factor as overall dividend yield. Internationally, I keep it really, really simple. I just choose an low cost index ETF that gets me access to all of the equities from around the world. There's great low cost products that do that for me. But I just choose one that excludes Canada because I already have the Canadian component with my individual stocks. And then for me, the bond component of my portfolio is pretty small. For some people, it'll be larger depending on your goals, your time frame, things like that. But again, I keep it really simple with the bonds as well, and I just choose a low-cost, broad-based government bond ETF.
Okay. So you've told us a little bit about kind of how you diversify, where you go to find these different pieces of your portfolio, but what's your personal approach to kind of that diversification outside of outside of the BTSX in your portfolio?
The first question to ask yourself is, okay, what is the asset allocation that makes sense for my personality, risk tolerance, time frame, goals, etc.? So overall asset allocation comes first, your ratio between stocks and fixed income. The next question, once you've figured that out, is to figure out what are your geographic allocation goals. How much of your portfolio should be Canadian versus US, international, emerging markets, et cetera. And you can break that down however it makes sense to you, but you should set targets for those things. Third, then, is particularly within Canada, what kind of sector allocation do you want to set your targets at? And then the last step is once you've set your sector allocation, then you finally get to the point where you're choosing the stocks that are going to satisfy those targets. So that's my approach to building a diversified portfolio. Asset allocation first, geographic allocation, sector allocation, and then finally stock allocation.
I think when we think about investing, sometimes we think about just the actual investing, like the buying securities part, but there's so much work that has to go into it before we actually get to that point of view. So I love the way you kind of broke it down about all the things that need to be considered before you actually jump into purchasing. So that's great.
People spend a lot of time worrying and stressing out about what individual stocks to buy, but really the more important decisions are those ones that come before that fourth step. They actually make a much bigger impact on your long-term success or failure.
Okay. Your second lesson is to avoid trying to time the market with buying and selling BTSX stocks during the year. How did this backfire on you in the past?
Yes, it has. Some of us have to learn things the hard way. I actually don't know a single successful DIY investor who doesn't have story after story of having to learn things the hard way, and I'm no exception. I used to hold a fair amount of cash in order to take advantage of quote unquote opportunities in the market. So I might hold somewhere between 5 and 15% cash in my portfolio with the purpose of, you know, buying when things were on sale. And so this actually worked as it should. It actually worked according to plan in early 2020 when the stock market dropped. Lots of stocks went on sale. I deployed that cash. I bought stocks when they were low. They rebounded. It all worked perfectly, except that when I actually looked back and objectively looked at my performance, I'd been holding that cash for long enough that if I really did the math, and which is what I did, I actually would have been far better off if I had just invested that cash as soon as I had it available and not waited for that opportunity. And it makes perfect sense because, as we all know, you know, it's time in the market, not timing the market. So holding cash now, what I've realized is that, you know, there's a huge opportunity cost involved in that.
It's good that you made those mistakes so we could all learn from them. Now, some investors might prefer to invest each month to get their money working for them as soon as possible rather than just once a year, as the BTSX method suggests. So, how could they employ dollar cost averaging when building a BTSX portfolio?
Well, investing early is definitely key for all the reasons that we've been talking about. Um, so, using money that's coming in on a monthly basis and just keeping it super simple and just buy a low cost index ETF. Could be one of these all in one ETFs, or it might be a Canadian ETF. It really kind of depends on what kind of portfolio you have and kind of your own method. But if you just buy a single low cost simple investment month after month after month, it keeps the labor that's involved in your portfolio maintenance low. And then at the end of the year, when you do the real maintenance and rebalancing to your portfolio, you can sell most or all of that ETF that you bought over the year and then use that money in order to do the rebalancing back to your targets. So I find that works quite well for most people.
All right, Matt, I find your third lesson particularly interesting. You say it's important to only invest in Beat the TSX stocks you're confident in and avoid those you aren't, even though this approach hasn't resulted in optimal performance. What makes you say that?
Well, what makes me say that is that really my own experience. When I got started building my own portfolio using Beating the TSX, I did follow it dogmatically, black and white. I bought every single stock on the list in equal parts, and I held for a year, and then just did the same thing over again the following year. And that definitely resulted in some good years, but I also got burned a couple of times. Particularly one year, there was two gold stocks that arrived on the list, and they did not have a real stable history, particularly when it came to their dividends, and they got decimated that year. And so after that, I took a bit of a different approach, and I started excluding stocks that I wasn't comfortable with. And the goal was not to be active. It was really just to build a portfolio that I was going to be able to stick with through the year. Again, it was to build a portfolio that I could just really be passive. The funny thing that happened though, again looking back, objectively as possible anyway, is that those some of those companies, many of those companies that I avoided because I wasn't comfortable with them, sometimes turned out to be the best performers. And again, it's not surprising because of the way that Beating the TSX works. It oftentimes companies will arrive on the list because their stock price is being beaten down because there are legitimate reasons to worry. But most of the time, these companies are big enough to recover from that and rebound. So there's these inherent contrarian plays built within the method. One of the axioms of investing and personal finance is the best plan is the one that you can stick with. So the truth is, there are some stocks that I just won't buy because I know that they're going to make me worry too much, and it's going to make it really hard for me to stay hands off of my portfolio for the year. But the majority of stocks, I will buy, even if there are legitimate reasons to worry. And I've learned over time that the method is better at choosing stocks than I am. That's really the bottom line.
All right. So, how do you actually personally put this lesson into practice when you're using the BTSX method?
So I tend to be as rules based as possible, take my own emotions and predictions out of the equation. So I look at the stocks and I buy them in approximately equal parts on an annual basis. I don't look at it any more frequently than that. I'm not super nitpicky about kind of getting those parts equal to the dollar or anything like that, because I'm doing my best, like most people, to balance some of these stocks across different accounts and things like that. But as a rule of thumb, I'll never have more than 5% of our portfolio invested in any one stock just because I have a particularly good feeling about that stock or anything like that. But on the flip side, I will occasionally invest less in one of those stocks than the others if I have serious concerns about it, but not enough to not buy the stock. I will kind of maybe go take a half position in that stock. Again, the goal is not to become an active manager in any way. It's really to build the portfolio that I'm going to be able to stick with no matter what happens throughout the year.
Now, there's research out there that suggests companies that cut their dividend payments often perform worse than companies that don't pay a dividend at all. Yet, your fourth lesson is to consider holding Beat the TSX stocks for the rest of the year, even if they cut their dividend. Why might you choose to stick with them?
There's a lot of different approaches on this. But in my experience, by the time a dividend is cut, the damage has already been done. There's been a recent example that probably a lot of the viewers will be familiar with, but in 2022, there was a very stable utility company that popped onto the Beating the TSX list for the first time. And it looked like it belonged there, to be honest with you. It had a great stable dividend, but over the course of the year, over the course of 2022, it missed earnings. There was poor forward guidance from the company. Analysts started downgrading it. It had a pretty high level of debt. And then when interest rates started going up, that did not look good for the balance sheet for the company. And so the stock price just tanked. By the end of the year, the stock price was a little bit less than half of what it had started yet. When it did announce the dividend cut at the beginning of 2023, what ended up happening is the stock price actually rebounded by 30%. So the stock price had been cut in half by the end of 2022. The dividend hadn't been cut yet, but that dividend cut had already been priced into the stock. Everybody was already expecting it. And so that's just one of many, many, many examples that the market is really quite efficient at pricing these kinds of stocks that we are looking at. It's already being worked into the price. I think it's really hard to implement that into a plan that's actually likely to generate excess returns. As individual investors, really what I've come to think is that these kinds of bad outcomes, dividend cuts, some stocks that just are lemons, that's going to happen with any portfolio. That's just investing. And individual investors can sometimes tend to take those events kind of personally. But I think it's important to realize that they're not mistakes that we make. They're just part and parcel of being a stock investor. It's just kind of the price we pay in order to get access to the really healthy long-term growth that stocks afford us.
Okay, very good. Your fifth lesson is to focus on dividend income rather than stock price. How can this be helpful to investors, especially during bear markets and times of high uncertainty and fear?
Yeah, I think we always feel like it's a time of unusually high uncertainty and fear. But if you study market history, it's pretty apparent that fear and uncertainty is actually the norm. Fear and uncertainty is actually the constant backdrop of the incredibly positive stock market performance, ever since stock markets have existed. So somehow you need to, or you'll be better off if you take the focus away from stock prices, because they are going to drive you crazy. I think one of the best ways to do that is really to focus on dividend income. And so I think that that's one of the big advantages of being a dividend investor. It's kind of a behavioral hack, so to speak. You know that even in a bear market, if you sell your holdings, then you're going to lose that dividend income. So that can become a behavioral aid. As for beating the TSX in particular, it actually has tended to do better than average, particularly in bear markets. I dove into the data on my website, wrote an article about a year or so ago. I looked at the 3 worst performing years over the last 30 years or so that we have data for the Beating the TSX. So I looked at the 3 worst years and what did Beating the TSX do that year and in the subsequent years. And Beating the TSX actually outperformed the index over the next 3 years. So beating the TSX seems to be quite resilient, even in times of uncertainty and bear markets. But also, it's worth saying that dividend stocks in general tend to be quite resilient for the simple reason that as stock prices go down in a bear market or a market crash, yields go up. And so dividend stocks tend to get more and more appealing as stock prices go down. So they tend to perform quite well, particularly in challenging markets.
All right, Matt, we're going to have to leave our conversation there. Thank you so much for sharing the lessons you've learned using the Beat the TSX approach. Before we go, let's reveal the answer to our trivia question. As a refresher, the question was, how many years has the Beat the TSX method outperformed the benchmark S&P TSX 60 index between 1987 and 2022? And the answer is the Beat the TSX method has outperformed the benchmark S&P TSX 60 index in 23 individual years between 1987 and 2022, or roughly 2/3 of the time. Its sharpest outperformance came in 1996 when it topped the index by 23%. Its sharpest underperformance came in 1999 when it trailed the index by more than 36%. So, Matt, as a numbers guy, scientific guy, did you already know this going into the answer, or is this new?
I have to admit, I didn't know the exact number. So thanks to you, I'm a little bit smarter today.
Listen, it's the least that we can give you after all the information you shared with us today. Thanks again for joining us, Matt.
My pleasure, Caitlin.
And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.